Ever wonder who actually intervenes when a nation's economy begins to collapse? Who makes the decisions about how to spend billions of dollars to assist countries escape poverty or recover from financial crises? The World Bank and the International Monetary Fund, IMF, are two influential organizations that can help with that. Despite their identical names and frequent news mentions, they have quite diverse influences on world finance. Consider them to be the two sides of a single coin. The IMF handles short-term issues that jeopardize economic stability, much like a doctor would. Like an architect, the World Bank creates long-term frameworks for infrastructure, development, and growth. Let's examine their operations, the difficulties they encounter, and the reasons why their choices have an impact on every aspect of the world economy. During the Bretton Woods Conference in New Hampshire, USA, in 1944, the World Bank and the IMF were both established. The globe was still in shock over the destruction caused by Globe War II. International trade was in chaos, currencies were unstable, and economies were in ruins. In order to create a new financial order that would restore stability, avert future crises, and foster prosperity, world leaders convened. Two important institutions came out of that meeting. Stabilizing the world monetary system is the goal of the International Monetary Fund, IMF, the World Bank, to finance development and rehabilitation. In a way, Bretton Woods represented an attempt to create financial shock absorbers in order to prevent the devastation caused by the Great Depression and World War II. The IMF's first goal was straightforward: maintain stability in the world economy. Its founders aimed to make sure that no nation's balance of payments issue or currency collapse could cause panic around the world. The IMF is based in Washington, D.C., and now has 191 member nations. Its responsibilities have grown over time to encompass financial advising, technical aid, and poverty alleviation, in addition to exchange rate management. Given how linked the world is, a crisis in one nation can have repercussions for numerous others, which is precisely where the IMF comes in. The IMF closely monitors the state of the world economy, much like a financial physician who performs routine examinations. It keeps an eye on patterns, recognizes possible dangers, and offers policy recommendations to assist nations in averting problems before they arise. The IMF examines how states are handling their finances and what global trends can jeopardize stability through publications like the World Economic Outlook and Article 4 consultations. Think of it as economic weather forecasting, identifying financial storms before they occur. The IMF offers short-term loans to nations experiencing balance of payments crises, which occur when a nation is unable to pay for imports or repay its obligations. However, these loans typically have requirements called structural adjustment programs. In order to restore stability and avoid a repeat of the crisis, borrowing nations are urged to implement difficult changes, such as increasing taxes, reducing government expenditure, or liberalizing their markets. Despite their ability to stabilize economies, these policies are frequently divisive. Austerity measures, according to critics, can harm common people by cutting back on spending on jobs, healthcare, and education. Saving the patient without making their misery worse requires a careful balancing act. In addition to loans, the IMF offers economic management training to nations. It provides technical support and training to enhance governance, create solid policies, and enhance financial systems. Consider it as assisting nations in creating their own economic immune systems, so they can withstand shocks in the future without external assistance. The IMF faces significant contemporary challenges even as it aids in economic stabilization. If nothing changes, global public debt might surpass 100% of GDP by 2029, according to IMF Managing Director Kristalina Georgieva. Repayment of debt is already a challenge for many low-income nations. If they default, it might set off domino-like chain effects in international markets. Though not equally, artificial intelligence is changing economies. Rich countries are advancing AI at a breakneck pace, while many developing nations lack the governance and infrastructure necessary to reap the benefits in a secure manner. The IMF supports global AI governance in order to make sure that technology reduces inequality rather than increases it. The IMF acted quickly during the COVID-19 pandemic, offering dozens of countries emergency funding and policy recommendations. Stabilizing economies, safeguarding the weak, and averting a global financial meltdown were its objectives. The pandemic, in many respects, strengthened the IMF's reputation as the global financial first response. The World Bank adopts a long-term perspective, but the IMF is more concerned with short-term stability. Its purpose: to encourage sustainable development and lessen poverty. The World Bank Group is a collection of 5 organizations rather than a single bank. Reconstruction and Development International Bank, IBRD. Association for International Development, IDA. International Finance Corporation, or IFC. A multilateral investment guarantee agency is called MIGA. ICSID, or the International Center for Investment Dispute Settlement. Each has a distinct function ranging from risk management and international dispute resolution to lending money and encouraging private investment. They are the foundation of international development finance. The World Bank prioritizes long-term initiatives that boost economies and enhance people's lives. It offers grants, loans, and technical assistance for projects in infrastructure includes water, energy, and road systems, medical care and education, food security and agriculture, resilience to climate change, building institutions and governing. Consider it the global project manager, providing financial blueprints for advancement. However, money isn't the only factor. As a knowledge center, the World Bank gathers a wealth of information and studies to inform international policy. Its publications, such as the World Development Report, provide in-depth analyses of topics like inequality, poverty, and environmental sustainability. The role of the World Bank has changed significantly in the last several years. The International Finance Corporation, IFC, demonstrates how it combines public and private finance to scale up development by completing a $510 million loan securitization deal in 2025 to draw private investment into emerging nations. The bank also keeps assisting nations in managing the sustainability of their debt. Many governments are forced to choose between funding necessities like healthcare and education and repaying debt. In order to ensure that countries can meet their basic requirements while also upholding their financial obligations, economists advocate for a more human-centered approach to debt. Climate change is another key area of concern. The World Bank has been allocating billions of dollars to environmental preservation, climate-resilient infrastructure, and renewable energy. It is a component of a larger movement toward green finance, which aims to prevent progress in the present from destroying chances in the future. You might compare it to modernizing an old plant, which is still productive but has been made cleaner and more efficient. Despite having different objectives, the IMF and World Bank frequently collaborate. The International Monetary Fund intervenes to stabilize a nation's finances when it experiences a crisis. The World Bank then pursues long-term initiatives to promote sustainable growth and repair infrastructure. According to the World Bank, it's similar to putting out a fire, IMF, and then rebuilding the house stronger than before. To make sure that international initiatives are coordinated and successful, they also work with institutions like the United Nations and regional development banks. Despite their widespread impact, both organizations have come under heavy fire. Many contend that IMF initiatives, particularly the so-called austerity measures, have the potential to exacerbate inequality and harm common people. IMF mandated spending cuts caused societal discontent, unemployment increases, and riots in nations including Greece, Argentina, and Pakistan. To its credit, the IMF has since changed its strategy, emphasizing social protection and implementing more adaptable programs. In the meantime, the World Bank has come under fire for allegedly supporting initiatives that uproot communities or damage the environment. For instance, thousands of people have occasionally been relocated by large dams without receiving fair compensation. Additionally, critics contend that the bank's governing structure favors wealthy nations above local needs and aligns programs with Western political agendas. To put it briefly, those who are supposed to receive assistance don't usually speak loudest at the table. The World Bank and IMF continue to be crucial cornerstones of international finance in spite of the controversies. The IMF helps nations weather crises by ensuring economic stability. The World Bank guarantees sustained expansion, hence facilitating their subsequent prosperity. They collaborate to cut down on poverty, encourage the development of sustainable, increase your ability to withstand financial setbacks. These institutions must continuously adapt in a society that is experiencing increasing debt, climate change, and rapid technological disruption. Balancing economic efficiency with equity and inclusivity. Because of the increased interconnectedness of the global economy, crises and solutions can spread more quickly than ever before. The World Bank and IMF are learning to adapt to the times, incorporating AI policy and digital finance into growth plans, giving climate resilience first priority in projects and loans, promoting sustainable investment and debt transparency, remaining relevant to the demands of the world's poorest people, not simply its richest, is essential to their future success. Because all boats, not just yachts, should be lifted by a rising tide. The World Bank and IMF were established in times of crises and still do so today. When economies falter, the IMF intervenes to maintain global stability. By providing finance for advancement and poverty alleviation, the World Bank acts as the creator of opportunity. When combined, they provide a safety net and a launching pad for underdeveloped countries. Whether the next century of global finance is equitable, sustainable, and inclusive will depend on their collaboration and reform as global issues change, from debt to digital disruption. Hit the subscribe button and enable notifications if you thought this breakdown was informative and would like to learn more about how global finance affects our globe. That way, you won't miss any updates.